Ever swiped your card, tapped your phone, or checked your bank app and thought, where does this digital money even come from? You might imagine huge printing machines spitting out cash like a scene from Money Heist. But here's the plot twist. Only about 3% of the world's money exists as physical cash. The other 97%? Created with a few keystrokes. And who has this magic keyboard? Banks. Yes, banks create money, not governments. And the craziest part? It's not only legal, it's the foundation of the modern economy. Buckle up. Because today, we're pulling back the velvet curtain on banking's most mind-blowing secret. How banks create money. Like actual, legal wizards. Let's rewind, way back. Before money, there was barter. A farmer trades wheat for a blacksmith's hammer. No money, just goods for goods. Simple, but kind of messy. What if the blacksmith doesn't want wheat? That's when money was born. First, shells, salt, silver. Eventually, coins and paper, things everyone accepted. But carrying heavy coins? Not fun. So people started depositing gold at Goldsmiths, the OG bankers, and getting paper receipts. Those receipts? People realized they could trade them instead of the gold itself. Boom. Paper money was born. But this is just the beginning. Now here's where it gets spicy. Let's say 100 people deposit gold at a goldsmith. Only 10 come back for it on any given day. So the goldsmith thinks, what if I lend some of this gold to others and charge interest? And that's exactly what they did. They started lending money they didn't actually have, just promises of money. This is the origin of fractional reserve banking. Today's banks took that idea and scaled it massively. Fast forward to today. Let's say you deposit 1 lakh rupees in your bank. Your bank is required to keep only a small portion, maybe 10,000 rupees in reserve. The rest, they can lend out 90,000 rupees. But here's the twist. When they lend it, it doesn't come from your account. It's new money created out of thin air, added to someone else's bank account. Now the economy has 1,90,000 rupees, and that borrower can deposit the 90,000 rupees elsewhere, and 90% of that can be lent out again. This keeps going. Each loan creates more money. That's why they call it money multiplication, and it's literally how 97% of all money in existence is made. You might be thinking, hold on, what if everyone wants their money back? That's called a bank run, and it's happened in real life, most famously in 2008. To prevent this, we now have central banks, deposit insurance, and tighter regulations. But still, the system runs on trust. If people lose faith, everything crumbles. Here's why this matters to you. When banks create money like this, it fuels the economy, but it also causes inflation. More money chasing the same amount of goods equals higher prices. Plus, it explains why your bank offers loans so easily. They're not giving away your money. They're creating new money when you borrow. And that's why debt isn't always bad. It's actually how the economy grows. But too much? Boom, crash, recession. So next time you see a bank ad saying, "We care about your dreams," remember, they're not just fulfilling dreams, they're minting them into existence. And that, my friend, is the real magic of modern banking. Did this blow your mind? Hit that like button if you learned something new. Subscribe Flipside if you want to master how the economy really works, not just what school taught you. And tell me in the comments, should banks have this much power? Or is it time for a new system?